Welcome to the Commodities Institute podcast. I'm Emily Costa, and today is January 7th, 2026. As always, we're here to slow things down, cut through the noise, and make sense of the forces shaping global commodity markets. Today's episode is one of those moments where everything feels connected: oil, agriculture, metals, power markets, even dry freight. The common thread is power. Who controls supply, who controls access, and who ultimately sets the terms of trade. Let's begin with oil, because this is where the geopolitical ground has shifted most dramatically. In a move that would have seemed unthinkable just a few months ago, Washington and Caracas have reached a deal that could send up to $2 billion worth of Venezuelan crude oil into the United States. The agreement allows between 30 and 50 million barrels of oil that had been effectively stranded under sanctions to flow directly to US ports. This is not just about barrels moving across the water, it is about leverage. For years, Venezuela's oil exports were funneled largely toward China, especially after US sanctions tightened in 2020. Now, this deal explicitly diverts those flows away from Beijing and back toward the US Gulf Coast. The timing matters. Venezuela has been running out of storage. Tankers were sitting offshore, loaded and unable to unload. Without an outlet, production cuts were inevitable. This agreement gives Venezuela breathing room while giving the Trump administration a political win it can point to immediately. But the structure of the deal is just as important as the headline number. The oil will be sold at market prices, yet the proceeds will not flow freely back to Venezuela. Sanctions remain firmly in place, and PDVSA, the state oil company, is still excluded from the global financial system. Bank accounts are frozen, dollar transactions are blocked. In practical terms, Chevron sits at the center of this arrangement. It is currently the only company exporting Venezuelan crude to the United States under a special authorization, shipping roughly 100,000 to 150,000 barrels per day. Any increase in flows is likely to move through Chevron-controlled channels. US refineries, particularly along the Gulf Coast, are well suited to handle Venezuela's heavy crude. Before sanctions, they were importing around 500,000 barrels per day from the country. Traders have already reacted. Heavy crude differentials in the Gulf slipped as expectations of additional supply filtered into the market and crude prices moved lower. The administration is also talking big about the future. Officials argue that Venezuelan output could rise quickly if sanctions are eased and US technology and capital are allowed back in. Skepticism is warranted here. Venezuela's infrastructure is severely degraded. Its oil is among the most expensive in the world to develop. Analysts see only modest gains over the next year, with meaningful recovery likely taking much longer and requiring billions of dollars. Still, perception matters. Even the idea of future supply can influence prices today. Now let's pivot to agriculture, where trade flows are telling a different story about US influence. China has been quietly but steadily buying US soybeans again. State stockpiler Sinograin has purchased roughly 10 cargoes this week alone, totaling about 600,000 metric tons. That brings total purchases from the current US crop close to 10 million tons, putting Beijing within striking distance of its pledged buying target. What makes this notable is the timing. These shipments are scheduled for March through May, which is peak export season for Brazil. Normally, South American beans would dominate global flows during this window. Yet China is still turning to the United States, despite a domestic supply glut and weaker demand at home. Currency dynamics are playing a role. The Brazilian real has strengthened, the US dollar has softened, and the price gap between US and Brazilian soybeans has narrowed. As a result, US beans are no longer wildly out of line. This buying has helped stabilize Chicago soybean futures and has given the market a psychological lift heading into the new year. But for many farmers, relief remains limited. Prices are better than a year ago, yet margins are still tight, and trade aid continues to play an outsized role in farm income. From agriculture, let's move into metals, where the mood is far more tense. In Europe, ThyssenKrupp is weighing a phased sale of its steel division to India's Jindal Steel International. The idea is to sell a majority stake first, possibly around 60%, with the remainder transferred later once restructuring milestones are met. This is about flexibility. ThyssenKrupp steel unit carries roughly €2.5 billion in pension liabilities, a major obstacle in past sale attempts. A gradual transaction allows those liabilities to be managed more carefully. For Jindal, this would mark a major expansion into Europe, building on its earlier acquisition in Central Europe. For Germany, it represents another chapter in the reshaping of its industrial backbone. Meanwhile, in India, the steel sector is facing a different kind of pressure. The country's competition watchdog has found that several major producers, including Tata Steel, JSW Steel, and state-run SAIL, breached antitrust laws by colluding on prices over multiple years. If these findings are upheld, the consequences could be severe. Penalties can reach up to 10% of turnover for each year of wrongdoing, and individual executives may also face fines. Markets have already reacted, with steel stocks sliding as investors assess the risk. This matters globally because India is the world's second largest steel producer. Any disruption to pricing power or output strategies there ripples through international markets. Turning now to carbon and power, legal battles are intensifying in the United States. Offshore wind developer Ørsted is challenging the government's decision to suspend leases for major wind projects along the East Coast. One of those projects, Sunrise Wind, is nearly halfway complete and was expected to start generating power in late 2026. Billions of dollars are already committed. Developers argue that national security concerns are being applied retroactively, creating massive uncertainty for long-term energy investments. These cases could set precedents that reshape how renewable projects are financed and approved going forward. At the same time, traditional energy infrastructure is doubling down. Energy Transfer plans to spend up to $5.5 billion next year, primarily on natural gas pipelines and processing facilities. The company is stepping back from liquefied natural gas exports, citing concerns about global oversupply and focusing instead on domestic demand, including growing needs from data centers. Finally, let's briefly touch on grains and freight-linked flows in Europe and the Middle East. European Union soft wheat exports are slightly lower than a year ago, though the data remains incomplete due to reporting issues. Barley exports, however, have surged, while maize imports are down. Romania remains the bloc's largest wheat exporter so far this season. In the Middle East, Jordan has secured 60,000 tons of milling wheat through an international tender, highlighting steady demand from import-dependent nations even as global prices fluctuate. When you step back, a pattern emerges. Energy security, food security, and industrial security are no longer abstract concepts. They are being negotiated deal by deal, shipment by shipment, and sometimes courtroom by courtroom. We are watching a world where access matters as much as abundance, and where politics and markets are once again inseparable. That's all for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.